Greetings, welcome to HouseLux Estate, your premier source for all things business. We're here to enlighten, educate, and engage with you on a myriad of business topics. Our mission? To bring you the most insightful and practical content. So, if you're hungry for knowledge, you'll want to ensure you're subscribed to our channel. Today, we dive into the fascinating world of capital structure decisions and their impact on company growth. So sit back, relax, and prepare to be enlightened. So what is capital structure? It's not as complex as it sounds. Imagine a company as a building. The capital structure is the blueprint that determines how the building is financed and constructed. It's the mix of various sources of funding a company uses to finance its overall operations and growth. This might include equity, debt, and even retained earnings. Think of equity as the portion of the company that's owned by shareholders. It's like the foundation of our building, the part that the owners have put in themselves. It's a riskier form of financing because if the company doesn't do well, the shareholders bear the brunt of the loss. But if the company thrives, they reap the rewards. On the other hand, debt can be likened to the bricks and mortar used in our building. It's borrowed money that the company has to pay back, with interest. It's less risky for the lenders because they get their money back regardless of how the business performs. Yet, it can be more risky for the company because too much debt can lead to financial instability. Retained earnings are a bit like the spare bricks left over from previous construction projects. They're profits that the company has chosen to reinvest in itself rather than distribute to shareholders. It's a risk-free source of financing because it doesn't require any additional investment or create any debt. The blend of these sources of funds makes up a company's capital structure. It's a strategic decision that company leaders make based on numerous factors like the nature of the business, the state of the market, and their risk tolerance. The right mix can fuel growth, innovation, and profitability. The wrong mix can lead to financial instability and even bankruptcy. It's a delicate balancing act, akin to constructing a building that's both sturdy and adaptable to changing conditions. Remember, the goal of strategic capital structure decisions is to maximize a company's value and reduce its financial risk. Now, what factors influence these capital structure decisions? Let's explore. First, there's business risk, the likelihood of a company not being able to cover its financial obligations. Higher business risk might push a company towards less debt in its capital structure, as it aims to keep fixed costs low and avoid the pressure of regular debt repayments. Conversely, a company with lower business risk might opt for more debt to take advantage of potential tax benefits. Next, we have the company's growth rate. Fast-growing companies often need substantial capital to fund their expansion. Such companies might prefer equity financing over debt to avoid the burden of regular repayments, which could potentially hinder their growth. On the other hand, stable or slow-growing companies might prefer debt financing as they can comfortably meet repayment obligations from their steady cash flows. Moving on, management style plays a crucial role. Some managers are more aggressive and willing to take on more debt to finance growth. In contrast, conservative managers might prefer equity financing to avoid the risks associated with high levels of debt. It's a delicate balance between risk and reward, and the management stance on this can greatly influence the company's capital structure decisions. Lastly, market conditions can significantly sway capital structure decisions. During periods of low interest rates, companies might be more inclined to borrow as the cost of debt is cheaper. However, during periods of economic uncertainty or high interest rates, companies might lean towards equity financing to avoid the added pressure of debt repayments. And there you have it. Business risk, the company's growth rate, management style, and market conditions. These are some of the key factors that influence capital structure decisions. Each factor carries its own weight and can tip the scales towards either more debt or more equity in a company's capital structure. Understanding these factors can help companies make informed decisions that support their growth. So, how do these decisions affect company growth? It's all about balance. In the quest for growth, companies must strike a delicate balance between debt and equity in their capital structure. This balance is not a one-size-fits-all solution, but rather a strategic decision tailored to the specific needs, opportunities, and risks of each business. Why is this balance so critical, you may ask? The answer lies in the concept of the cost of capital. Each source of capital, whether it's debt or equity, comes with its own costs. Debt requires interest payments, while equity involves sharing the company's profits with investors. The optimal capital structure is one where the total cost of capital is minimized, thereby maximizing the company's value and paving the way for growth. Let's delve a bit deeper into the dynamics of debt and equity. A high level of debt can provide a company with the necessary funds for expansion, acquisitions, or other growth opportunities. However, it also comes with risks. High debt levels can lead to increased financial risk and potential bankruptcy if the company is unable to meet its debt obligations. Furthermore, the cost of debt increases as a company takes on more of it, which can erode profitability and limit growth. On the other hand, equity financing allows a company to raise capital without incurring debt. This means no interest payments and less financial risk. Moreover, investors who buy equity share in the company's potential upside, providing an incentive for them to support the company's growth initiatives. However, equity financing also means sharing control and profits with investors, which may not always align with the company's long-term goals. So, what's the takeaway here? A well-balanced capital structure, one that combines the right mix of debt and equity, can help a company navigate the financial seas, weather the storms of risk, and sail towards the horizon of growth. It's a dynamic, ongoing process that requires careful analysis and strategic decision-making. It's important to note that the optimal capital structure can change over time as a company's circumstances evolve. Market conditions, business strategy, profitability, and risk tolerance are all factors that can influence the ideal debt-equity mix. Therefore, companies need to regularly reassess their capital structure to ensure it remains conducive to their growth objectives. In conclusion, capital structure decisions are not just about raising funds. They're about shaping the company's financial future. By choosing the right mix of debt and equity, companies can minimize their cost of capital, maximize their value, and set the stage for sustainable growth. And remember, while high debt levels can provide a quick boost, they also come with risks. Equity financing, while diluting ownership, can offer a safer route to growth. The key is to balance the two, taking into account the unique needs and risks of the business. By making wise capital structure decisions, companies can effectively fuel their growth. And there you have it, an overview of how capital structure decisions impact company growth. We've explored the concept of capital structure, the factors influencing these decisions, and their profound impact on company growth. It's clear how strategic capital decisions can be the driving force behind a company's success. If you found this video helpful, don't forget to subscribe to HouseLux Estate for more insightful business content. Until next time, stay informed and keep growing.